What is account coding? Coding means assigning a unique number to each account in the chart of accounts. Think of it like a postcode system for your finances. Every account gets its own location number, so it can be found, grouped, and summarized easily. These numbers are called account codes or nominal codes, and they make it much faster to enter transactions consistently, sort or filter accounts by type, and prepare financial statements automatically. Why coding is useful? Consistency. Everyone in the finance team uses the same numbering system, so for an example, code 6000 means wages, not something random. Speed. You can post transactions quickly without searching long account names. Reporting. Codes help your software instantly group totals for assets, liabilities, revenue, and expenses. For example, if all expense codes begin with 6, you can easily pull out all your costs by asking the system to total anything that starts with 6. In this table, we can see how each account in the business is given its own account code and category. For example, bank account has the code 1000, which falls under current assets. Money the business owns. We use different code ranges for different types of accounts. Assets and liabilities, both current and non-current. Cost of sales and overheads for running costs. Administrative expenses, revenue accounts, and owner's equity, which shows how much the owner has invested in the business. How it works in practice. Let's say we're recording a transaction for office rent. Instead of typing office rent expense every time, we can simply type code 7000. The system knows this means rent expense. If we then record utility expenses under 7,100 and insurance under 7,200, our software can easily produce a total for all accounts in the 7,000 to 7,999 range, which we know represents administrative costs. There's no legal rule saying your bank account must be 1,000 or your capital must be 3,000. These are just conventions, agreed upon structures that make it easier for accountants across businesses to read ledgers. A company might decide to start its sales at 4,000, while another might use 100 for the same purpose, and that's fine, as long as it's consistent throughout that system. In larger businesses, codes can have more detail. For an example, 7000-01 might mean office rent, London branch. 7000-02 could mean office rent, Manchester branch. The first part of the code shows the type of expense, and the second part identifies the department, project, or location. Let's look at what those codes represent in real terms. Every code belongs to one of two big families in accounting, assets and liabilities. This is where the coding system connects directly to the double entry system. In accounting, we divide assets and liabilities into short-term, called current, and long-term, called non-current categories. Current assets business owns or expects to use or turn into cash within a year. Examples: bank balance, cash, accounts receivable. Non-current assets, also called fixed assets, are assets the business uses for longer periods, usually more than a year. Examples: equipment, vehicles, buildings. The same logic applies to liabilities. Current liabilities are debts the business expects to pay off within 12 months, like accounts payable or short-term overdrafts. Non-current liabilities are longer-term debts, like bank loans or mortgages that will take years to repay. Now we use those assets, liability and equity codes in real journal entries and T accounts. When a transaction happens, for example, the owner invests £10,000 and the bank grants a £50,000 loan, then the business buys computers for £6,000. Each of those accounts will appear in the ledger using their category-based codes. Example: the business receives £10,000, so cash in the bank increases. This is a debit entry in the bank account, code 1000. At the same time, owner's capital increases. That means the owner now has a claim over the business. This is a credit entry in the owner's capital account, code 3000. Business received £50,000 loan from the bank. Again, the bank account increases because we've received money. Debit bank account £50,000. But now, the business owes that £50,000 to the bank. It's a liability. Credit bank loan account £50,000. Business purchased computers for £6,000, including £1,000 VAT. The bank decreases because money is going out. Credit bank account £6,000. The business owns new computers, so our assets increased. Debit computers account £5,000, which is excluding VAT. The VAT on the purchase is recoverable, meaning HMRC owes us that amount. We debit VAT on purchases account £1,000. The double entry tables and T accounts show how all these coded accounts interact. Current assets increase debit side, while capital and liabilities increase credit side.